Welcome back. We now investigate the most common ratio for comparables, the price-earnings ratio, far and away the most common. We're going to just do a normal example. We're going to assume the cost of capital is 10%. What should be the price-earnings ratio of a firm with a 5% long-run growth rate?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, the simplest approach is consider the long run to be eternal. We're going to take the formula that we've used before, which is the growing perpetuity formula, which is right here. P equals E divided by R minus G. So move the E over to the other side, and that tells you that the PE ratio should be about 20. What should be the PE ratio of a firm with a minus 10% eternal growth rate?
Please pause this video now, answer the question on a piece of paper, and then continue.
I'll use the same formula. Just plug in minus 10% this time, and the answer that you get is 5. Are PE ratios typically higher for growth or value firms? So if you look at the previous one, we had a value firm that had a minus 10% growth rate. So it wasn't growing anymore, it was actually shrinking. And then before we had a growth rate, a firm that was growing up. So just compare this and figure this one out for yourself. Are price earnings ratios higher for growth or value firms?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, PE ratios should be higher for growth firms. If you think about this, every dollar of earnings today translates into a lot more earnings in the future. So a dollar worth of earnings today is worth a lot more price. It's worth a lot more value than the equivalent where the earnings next year are almost all shrunk or forgotten or don't appear again. So still assuming the cost of capital is 10%, furthermore, earnings will be $1 per year. What would be the appropriate value of this firm if its growth rate will be forever? And then there's a table that you have to fill out.
Please pause this video now, answer the question on a piece of paper, and then continue.
So the answer to this question is we're going to use $1 divided by R minus G. For example, for minus 10%, the value is $5. And here is the table. If the growth rate is 0, it's worth $10. If the growth rate is minus 10%, it's worth $5. If it's minus 20%, it's $3.33. If the growth rate were 10%, the value would be infinite because you would be dividing $1 by 0, which means it would be infinite. Now we're going to cover another concept called the PVGO, the present value of growth opportunities. It's the relative difference between the value of the firm and the value of the firm if it had 0% growth. What is the PVGO of the 4 firms from the previous slide that we just had, which is this one, where minus 20%, minus 10%, 0, 5, 10, different growth rates. So create a table for me that tells me the PVGO of all these 5 firms, not 4 firms.
Please pause this video now, answer the question on a piece of paper, and then continue.
And here are our 5 firms. The firm that has 0% growth rate, of course, has no present value of growth opportunities. It doesn't grow. It's just 0. Now, if it grows by 5%, then the value of this firm previously was $20, which means that $10 is due to the growth opportunities and $10 was the base value. Similarly, for the firm that has minus 10% growth, well, that firm is now worth only $5. So the present value of the growth opportunities takes away $5 from the $10 that it would have been if it had stayed stable forever. This turns out to be a very common question on the CFA exam. Now, give a few examples of firm pairs that you think would make great comparables for one another. So how about this one? Take Coca-Cola, take PepsiCo. So both of them are big, large soft drink manufacturers and have a couple of other things. Or take Hyundai versus Toyota versus Daimler-Benz versus Tesla versus Ford. All of them are car companies. Presumably, they all have been around for a while. They are not growing greatly anymore. They're fairly stable. Presumably, they should have similar price-earnings ratios. Well, if you do a little bit of research, though, you will find that none of these companies are really all alike. So they can differ in geography, where they sell. So for example, Coca-Cola and PepsiCo in the past had different markets in Russia and in China. One had Russia, one had China. Even to this day, there is still some difference in the market penetration in China versus in Russia. They have different tariffs. They have different markets. They have different capital structures. They may have different growth potential. So many people believe Tesla has a lot more growth potential than all the other car manufacturing companies. They may differ in profitability. They differ in accounting methods and fiscal years. In the subsidiaries that they have, Frito-Lay is owned by, I believe, PepsiCo, not Coca-Cola. And there is just very many different small changes. And it's not so clear that all of these companies are really the same thing. So take a look at them, see whether their price earnings ratios really are the same. And sometimes they aren't the same at the moment, but maybe a year later they will be. Now, guess the price earnings ratio of a few companies before you look them up. Alphabet, Goldman Sachs, Altria, which is Philip Morris, which is a cigarette manufacturer, and maybe a few more. So just guess them before you look them up. And then tell me whether your guess was sort of intuitively right. How good are your PE ratios for valuing firms? That's a tough question. You tell me. The answer changes from day to day. Now, if PE ratios are good predictors, maybe we should buy the firms with a low price earnings ratios and short the comparable with a high price earnings ratio, then hope that those are going to converge in terms of price earnings ratio, and therefore that we're going to make money. That the firm with a low price is going to get a higher price, and the firms with a high price are going to get a lower price. And this is a question that we can only answer empirically. So we have to take a look. Following year is as of 2021. Other years would look fairly similar. The reason why I use 2021 is because at that time I had a whole cross-section of analysts' earnings forecasts, and they are a little bit more difficult to get into merge. It's not super difficult, can be done, but it takes quite a bit of work. And the result would look almost exactly the same way. So I'm going to use G as the number for the analyst's forecast of the growth rates of the earnings of a company. So analysts would go out and they would say, we expect Tesla's earnings to grow by 30% next year. And then we want to ask is, one of the questions that we earlier addressed, should higher growth firms have higher or lower EP ratios or price earnings ratios, which are exactly the opposite? How good, noisy, bad should our prediction be? And here is the answer. And it's not at all what you expect it to be. So on the y-axis, you have the value of the firm. And when you have a really large value, when you're a giant, when you're worth trillions of dollars, there isn't that many firms that actually float there. So there was Amazon, there was Microsoft, there was Google. Facebook at that time was still a bit bigger. It hasn't done so well since then, but it also was worth about $1 trillion. Then there were a couple of industry giants. So companies like Johnson, which produces consumer products, Bank of America, very, very big companies, not as big as the tech giants, and they are sort of in the middle region over there. And then you have hundreds of firms that have values between $100 billion and $500 billion. And then when it comes to firms worth less than $100 billion, there was just thousands of publicly traded firms. So what were their earnings in 2021? Well, they were all over the place. And in fact, some of the companies actually lost money. So if you look on the left side of this graph, you will see some companies in red, they lost money. Now, here is a more interesting graph. We're going to graph the growth rate of earnings, the things that we talked about before, the G that helps us with the present value of growth opportunities and the PE formula, and we're going to put that on the x-axis. And on the y-axis, we're going to have the earnings price yield, which is the inverse of the price earnings yield. And when you think about this may take you a moment to get the intuition. The theory predicts that what we should be getting here is a line that sort of, not maybe a line, but something that sort of slopes downward. Because what we want is if you have almost no growth rate of earnings, your price doesn't represent a lot of the future earnings anymore. It's more like today's price. So your earnings price yield should be relatively high. And then for firms that have huge growth rate, your earnings price yield should be smaller because the earnings today represent a smaller part of the value in the future. And if you look at this graph, there isn't really that much there. It doesn't really look like there is this tendency of what we just saw, the theory tells us we should have seen, which is this line that is downward sloping. So maybe we can do a little bit better by looking at what analysts are telling us about their expected growth rate. If we see both of those, what could possibly go wrong? Okay, so we're going to put the growth rate of earnings, how fast they were growing. And usually when they grow fast for a while, they're still high growth companies. And we're going to add the earnings yield to it. So that is the thing on the x-axis here. And we're going to try and use this to see, can we predict the future stock return? That is, can we make money trading this? So if I have a firm that has a huge growth rate of earnings and a very high earnings yield, so I get a lot of money immediately, presumably this should mean that from today to next year, I should be making a lot of money. And you look at this and it's just not there. So in a sense, it's somewhat depressing. So we have this beautiful theory, tells us what there should be. And if anything was off this theory, it should tell us how we can make money. But in the real world, that isn't so. It looks like we are more in an efficient market framework, and convergence of prices to maybe some long-run value is not as great, or our forecasts of earnings and earnings yield and growth rates are not so great. And I'm going to venture a guess we are much worse with our forecast than the market is. But it's really hard to put this theory for making money, for actually systematically trading and making money. So PE ratios, as nice as they sound, as convincing a theory that we have, empirically, they're just not very satisfying. So they were not so good at explaining or predicting value. Now, if you remember what we did last time, we started this whole comparables by saying, oh, wouldn't it be great if we had a method that worked much, much better than net present value? And I said, yeah, look, price earnings ratio should work great. And we look at price earnings ratio, and yes, they should look great. But the fact is, they don't look great. So that's a problem. The theory does not work as well. So maybe net present values aren't altogether redundant and not useful anymore. That's it for this video and for the use of price earnings ratios. In the next video, I'll explain to you why neither price earnings ratio nor other comparables ain't so very good much of the time. They have some conceptual problems on top of this. So see you soon. Bis bald.
Honey, our kids are off to college soon.
Don't worry, darling.
I can't fathom losing them.
Don't worry, darling.
They may forget about us.
Don't worry, darling. Money isn't everything, but it sure keeps the kids in touch.